For more on this, we want to bring in Lee Munson. He's Portfolio Wealth Advisors President and Chief Investment Officer. And Lee, it's great to have you back on the show. Let's just talk about this recent rally that we've had, really up from those March lows as it stands right now, not far from those record highs, tech becoming a defensive play over the last several months. What's your view on the market right now, and can we continue this move to the upside?
Oh, I think you continue the move to the upside. Remember, if you take the NASDAQ 100, which is 99% within the S&P, it makes up like 40% of the market cap for the S&P. So as money flows in, it doesn't matter if people are just flowing in money into the Qs right now or into the spiders, it's gonna flow in and it's gonna keep that momentum going. For me though, I wanna know where I wanna continue to put in money. I'm not adding more to the tech because that is a defensive. And that's so weird because 20 years ago, that was not a defensive play back in the dot-com days. So I'm looking at what do I think over the next year to 3 years? What is the COVID recovery places? And you're not gonna buy those at a good price unless you're buying a COVID recovery in a moment of pessimism, and that's right now. So that's why we're looking at some of these other places like mortgage REITs. I'm not afraid of saying it, right? Mortgage REITs have been nothing but beat up. A lot of the dividends have been cut or suspended. It's a bunch of dogs, but here's the thing. Those mortgage REITs, they don't have to worry about how they're gonna hedge their interest rate exposure for the next couple of years as Jay Powell keeps interest rates under control. And so that's a place where you can get, they're paying over 10% of interest post reduction, post blow up. So I think that's a place where you can get some yield. I think to some people it could be a bond alternative. And then you get into master limited partnerships. You notice we're not talking about oil at $40 a barrel, which it is right now. It's been left for dead because the easy money's off the table. But you're also looking at 10 to 12% overall in that group of master limited partnerships. 10 to 12 is, if you can compound to 10 or 12 over the next 3 years, you're gonna rock. And the valuations are left for dead. And then my third thing is, I'm still long the gold miners, right? I know that it's popped this week because, we've heard that Warren Buffett bought some Barrick Gold or whatever. But if you still think that there's gonna be low interest rates going forward, and if you think that that's gonna help long duration assets like tech stocks, gold is that other asset class that's been doing, especially the gold miners, that's been doing just as well because we have negative real rates. And I don't care if inflation picks up a little here, because as long as the difference between inflation and the treasury is negative, that's what is driving gold. We saw this 20 years ago from 2000, 2006, where the 10-year treasury was sort of sitting at 4%, give or take for years, but inflation was picking up while that was happening. And so real rates were pushing down from say 4.5 below 2. And that's what was driving gold. I didn't really understand that 20 years ago, and I'm not gonna make the same mistake this time around.
So Lee, as you've noted, you were around 20 years ago. You got to see the whole dot-com implosion. If you look at the Apple chart, check that chart out. It's crazy. It's crazy. It's a $2 trillion company. If you back it out, it's just going, you've lived through this before. You've got 5 companies basically in charge of the market. It's nice to hear you're looking at MLPs and you like gold, but do you not see a crash, a cliff, a bubble, something on the other side of this trajectory for tech?
I see that, but I think that the most likely outcome will be worse. I think that I want to give a hat tip to Walt Deemer, who's kind of like one of my oldie moly favorites. I should check him out on Twitter and buy his little book. But he always talked back in his day about McDonald's from 1970 to say 1979. It was one of those big fang type stocks at the time where you could have Apple continue to grow revenues. They've hardly done it recently. And instead of seeing a crash, you just see the stock do nothing for years and years and years while their earnings start to catch up with the valuation. And that's that type of insidious sideways action. Remember in 2000, you had stuff like Coca-Cola and General Electric, not tech stocks, that just sidelined for 10 to 15 years. So I think investors need to realize Apple may continue on being the greatest company ever. It may continue to slowly grow its subscription-based revenues, which is what all the analysts, the only thing they care about, but you may see the stock sideline. And what's that going to do? It's going to cause the S&P to really have trouble moving upward. But, I think your guess is as good as mine. We haven't seen the trends. If you look at the charts too, I'm not seeing as horrible of charts across the FANG stuff as much as I saw in .com. But I think you and I feel each other. I'm clearly in the camp of I want to get to the cheap, I want to get to the value, I want to get away from tech. So while the S&P is my largest position, I own no other tech positions outside of our core S&P. And as we add stuff, I'm not adding any money to the S&P. I'm adding to large value, emerging markets, small value, and then again, miners, MLPs, mortgage REITs. I know it's a long-winded response.
Lee, we only got a minute here, but I want to ask you quickly, just what are your thoughts on Tesla? And I know you're saying that you're going for those downbeat plays, names that haven't seen this massive rise, but Tesla above $2,000 a share. Really quickly, what's your reaction to
that? I remember 20 years ago when Yahoo was worth more than General Motors. And we all thought it was silly, but I remember still being bullish on Yahoo stock when it was $250 a share. So, everything seems like it's fine until it's not. I would not be long Tesla. I think that General Motors is probably a better way to play it because they actually have the wherewithal to compete with electric. So I would say I wouldn't short it. Have as much fun as you can making money off of Tesla, but don't call me when it blows up.
All right. We won't call you. And actually, no, we will call you when it blows up because we'll want to know your reaction to that. But Lee Munson, Portfolio Wealth Advisors President and CIO, always great to have you on. Thanks so much for taking the time to jump in today.
Thank you.